All right, let's just cut right through the noise and jump straight into this financial teardown of Hyatt Hotels. We're looking past the headlines today to uncover the hidden engine driving this business.
So setting the stage here, we're looking at a $16.8 billion market cap, trading right around $178 a share. Now, if you're a classic value investor, well, Hyatt's headline PE ratio is probably going to make your eyes water. It looks sky high. But wait, this is exactly why we need to peel back the layers. See, their reported GAAP earnings are heavily depressed right now because of some massive, totally intentional structural changes happening under the hood. Looking just at the traditional PE here, it's literally like judging a book by a temporary dust jacket. It's going to give you a wildly distorted view of their actual cash-generating power. We really need to measure the real engine driving the business beneath those surface-level accounting figures.
Because the entire foundation of the Hyatt investment thesis, it really all comes down to a radical shift in their identity. I mean, historically, hotel companies owned the physical buildings, right? Think about what that actually entails. You've got massive real estate costs, totally unpredictable construction delays, you're constantly fixing roofs and plumbing, there's heavy labor overhead, and just brutal property-level operating risk if a recession hits. Well, Hyatt is aggressively shedding that heavy armor. They are transitioning into this lean, asset-light, fee-generating machine. They just want to manage the experience and franchise the brand. Let someone else deal with the bricks, the mortar, and those heavy commercial mortgages. It completely rewires the risk profile of the business.
The ultimate goal here is brilliantly simple, honestly. Grow the global network, but don't get left holding the bag on the real estate. So, when Hyatt adds a new hotel to their network under a management or franchise contract, the financial magic kind of just happens. They don't have to shell out hundreds of millions in CapEx to build a shiny new tower or buy up prime coastal land. Instead, they just plug that new property right into their existing global reservation system and loyalty program. And boom, that incremental room growth turns directly into highly attractive, recurring free cash flow, with minimal friction and practically zero capital investment on their end.
Which brings us to arguably the most important number in this entire explainer, 148,000. That is Hyatt's contracted pipeline of rooms, which was up about 7% year over year at the end of 2025. And because of this whole asset-light strategy, this is not a pipeline of looming real estate debt, not at all. It's a pipeline of future management and franchise contracts that are already inked. You know, today's contracted rooms are quite literally tomorrow's high-margin fee revenue, just waiting to be unlocked. For an investor, that represents embedded, highly predictable growth that is already locked into binding agreements.
In practice, this sets up a super efficient three-step financial flywheel. Step 1, a third-party real estate developer takes on all the heavy lifting. They secure the loans and they absorb the risk to fund the actual construction of the property. Step 2, Hyatt swoops in, injecting that brand prestige, their global marketing distribution, and their highly refined operating playbook. And finally, in Step 3, Hyatt just skims recurring management and franchise fees right off the top of the revenue generated. It's beautiful. They transform that 148,000-room pipeline into a massive, low-risk cash engine that practically runs itself once the doors actually open.
You can actually see the lucrative reality of this model baking right into their 2026 guidance framework. We're looking at a steady net rooms growth of, say, 6 to 7%, but pay really close attention to the leverage happening below the surface here. They're projecting gross fees to totally outpace room growth, increasing roughly 8% to 11% to reach up to $1.33 billion. And even better, adjusted EBITDA is expected to jump 13% to 18% from 2025 levels. Guys, that is the literal sound of margins expanding. For your portfolio, it means the company is getting fundamentally more profitable with every single new hotel they open.
And this right here reveals the absolute holy grail for hospitality investors, EBITDA growth substantially outpacing RevPAR growth. Now, RevPAR, revenue per available room, that's the industry's classic health metric, right? And their guidance only expects a super modest 1 to 3% growth there. But think of operating leverage kind of like running a software company. Once the code is written, selling the 1,000th copy costs you basically nothing, so it's pure profit. Because Hyatt's asset-light model spreads fixed costs across a growing footprint, that tiny little bump in room rates supercharges their adjusted EBITDA by up to 18%. Bottom line, Hyatt doesn't even need a red-hot booming economy to generate serious compounding cash.
Now, to understand how they command those premium fees in the first place, we have to look at their deliberate and, frankly, aggressive push into the all-inclusive and luxury spaces. We're talking top-tier brands like Secrets, Dreams, Zoetry, and Impression. By dominating this high-end segment, Hyatt is basically building a fortress against the usual volatility of traditional corporate business travel. They're going after highly affluent, much less price-sensitive guests who book longer vacations and honestly spend a lot of money while they're on the property. Hyatt doesn't just want to rent them a room for a Tuesday night business trip, they want to own the entire premium customer relationship from start to finish.
And the data validates this luxury pivot absolutely perfectly.
While system-wide hotel RevPAR grew by a respectable, 2.9% in 2025, the all-inclusive segment was an absolute powerhouse. It delivered a massive 8.6% growth rate. Turns out, affluent travelers will absolutely pay a premium to have their margaritas constantly refilled without ever having to sign a tab. The all-inclusive category is driving higher per-guest spending, it's creating incredibly sticky brand loyalty, and it's proving to be a remarkably resilient revenue stream, even when broader consumer spending starts showing signs of fatigue.
But the hidden glue holding this entire ecosystem together, that would be the World of Hyatt loyalty program. It creates this textbook network effect that forms a massive competitive moat. Guests join the program, which strongly incentivizes direct bookings, meaning they bypass the online travel agencies, saving the hotel owner an absolute fortune in third-party commissions. This high customer retention generates superior cash flow for those third-party owners. And hey, when hotel owners make more money, what happens? More developers want to fly the Hyatt flag on their new buildings. The network expands, it attracts even more loyal guests, and it allows Hyatt to punch way above its weight class against the industry titans.
And speaking of those titans, the competitive landscape offers a really fascinating dynamic. Marriott obviously has undeniable, massive scale. Hilton has been mastering the asset-light playbook for years now. But while those competitors boast substantially larger global footprints, Hyatt's perceived weakness, its smaller size, is actually its most potent advantage right now. Because they are smaller, Hyatt just has a massive runway of white space left to conquer. They boast the best relative room growth potential in the industry, simply because there are so many premium global markets they haven't even saturated yet. It gives them a much longer trajectory for rapid expansion.
However, look, no investment is without its turbulence, and we have to remain totally objective here. Despite actually beating overall expectations in their Q2 2026 report, Wall Street's reaction was notably cautious. Investors started, nitpicking. They focused heavily on some slightly softer resort trends, and they really scrutinized the exact timing of when new hotels in that pipeline would actually open their doors. And the market is right to ask the tough questions. If global consumer travel starts to cool off, can Hyatt continue growing its footprint fast enough to justify that premium stock price? Expectations are incredibly high right now, and any slight deviation in the timeline is going to create volatility.
When we stress test this business, the balance sheet is definitely the glaring area of concern. I mean, Hyatt's aggressive expansion hasn't exactly been cheap. It's relied heavily on massive acquisitions, like the Apple Leisure Group. And while that was brilliant for geographic expansion, it saddles the company with some pretty significant debt. In a higher-for-longer interest rate environment, that debt servicing can aggressively eat into free cash flow. There's also execution risks to consider. They still need to successfully sell off billions in legacy-owned real estate to actually complete this whole asset-light transition. Plus, at the end of the day, lodging is discretionary spend. A true economic recession is going to compress room rates universally, no matter how strong your brand is.
Oh, and if you're a dividend investor, you might want to shield your eyes for a second. With a quarterly payout of just 15 cents per share, Hyatt offers an almost microscopic 0.3% annualized yield. So let me be perfectly clear. You absolutely do not buy this stock to collect a quarterly check. No way. If you're parking your money in Hyatt, you are making a pure play bet on aggressive capital appreciation. You're betting on room growth, accelerating fee generation, and expanding EBITDA margins. This play is all about explosive capital growth, definitely not a steady retirement income stream.
So because we've already established that their standard GAAP earnings are essentially a mirage right now, heavily distorted by depreciation on old properties and complex one-off asset sales, you really have to just throw the traditional PE ratio in the trash. To find the truth, Wall Street analysts are looking at enterprise value to EBITDA, enterprise value to fee revenue, or price to free cash flow. These metrics are great because they strip out all that messy accounting noise. They measure the actual hard cash the business is spinning off from its core operations to see if that premium stock price is actually warranted by the money hitting the bank account.
Okay, let's map out the actual valuation scenarios, starting with our stark red bear case, which models a drop down to the $135 to $155 range. This painful contraction triggers if, say, a global recession forces consumers to just slam the brakes on travel. If we see declining RevPAR, a sharp pullback in luxury resort spending, and jittery developers suddenly freezing construction on that 148,000-room pipeline, well, Hyatt's valuation multiple is going to get compressed rapidly, especially given their current debt load. Whenever the economic music stops, the heavily leveraged players are always the ones who feel it the most.
Moving over to the base case, we're modeling a target of $190 to $215 over the next 12 to 24 months. Think of this scenario as the steady, reliable compounder. It essentially assumes we avoid any major macroeconomic shocks.
Room rates tick up a modest 2 to 3%. Room growth holds firm at roughly 6%, and that beautiful operating leverage we talked about kicks in, pushing EBITDA up 10 to 13%. It's not an overnight rocket ship, sure, but it is a highly predictable, wealth-building machine that quietly grinds higher year after year.
But in our bull case, the green zone, we're looking at a massive 25% to 40% upside, pushing the stock well into the $220 to $250 range. Now, this requires flawless execution. But if they aggressively convert that massive pipeline into open, operating hotels, if they sustain their dominance in the all-inclusive sector, and they drive fee growth deep into the double digits, the math entirely changes. In this scenario, Wall Street eagerly rewards their fully realized asset-light transformation with a massive premium multiple, basically pricing in years of future unimpeded cash flow generation.
So pulling it all together into an actionable framework for your portfolio. Trading around $178 today, the stock sits squarely in the accumulate or hold zone. It is undeniably a high-quality, growth-oriented asset. Is it a screaming deep value bargain right this second? No. Probably not. But it is a phenomenal business that you should definitely aggressively scoop up during broad market pullbacks. If market volatility temporarily drags this below 170, it becomes a highly compelling buy for the long-term investor who really understands the underlying mechanics here.
Ultimately, this whole teardown reveals one fundamental truth. If you buy Hyatt today, you aren't betting on last quarter's hotel bookings. You are betting on a hidden, highly efficient financial engine designed to absolutely dominate the future of premium travel. So I'm going to leave you with this to consider for your own portfolio. As Hyatt completes its radical evolution from owning concrete buildings to owning the lucrative luxury customer, is this high-margin transformation happening fast enough to justify the premium you have to pay at today's price?